All right, so we're diving into Jupiter Wagons Limited's Q2 FY25 results. And wow, you sent over a lot. Their financials, investor presentations, and even a statement from the managing director. So
Yeah, it's quite the information dump.
it is quite the information dump. But we're going to try to break it all down, what these numbers really tell us about Jupiter Wagons,
Yeah.
how they're doing and where they might be headed.
Yeah, what I find interesting is that Jupiter Wagons, they seem to be doing really well in their traditional business, but they're also making some pretty big moves in some new areas like electric vehicles.
Yeah.
So they're clearly not content with just staying in their lane. They're
Yes.
looking to really shake things up.
Yeah, it's not just about riding the wave. It's about like building a whole new boat, right?
Exactly.
Um, so let's start with the core business. Their revenue jumped by almost 15% year on year, reaching over 100,904 lakh on a consolidated basis. So
That's a pretty impressive jump.
that's a pretty big jump. And it turns out that's pretty consistent with what's happening across the entire wagon sector.
It seems like there's a real boom happening.
Yeah, there's a real boom.
Exactly. And what's even more impressive is that they're not just growing, they're doing it profitably.
Right.
Their profit after tax, or pay-T, which is essentially the money they keep after all the expenses are paid, also increased by almost 9%, hitting 8,936 lakh.
Okay.
And that translates to a PAT margin of 8.8%, which means for every 100 rupees they make, they're keeping 8.80 as profit.
Wow.
That's a pretty healthy margin, wouldn't you say?
Yeah, definitely. And it's not just a one-time thing either.
Exactly.
If you look at their EBITDA margin, which measures their overall profitability from operations, it's actually improved both for Q2 and for the first half of the fiscal year.
Right.
This tells us they're becoming more efficient at what they do.
Now, it's important to note here that we're talking about the consolidated figures, which include all their subsidiaries.
Right.
But even if you look at their standalone numbers, which represent just the core wagon business, you see a similar story.
Okay.
Revenue up by over 10%, PT up by 8.6%. It's like they've mirrored that success in the consolidated performance.
So they're doing well in their core wagon business, and that consistent performance is probably reassuring for anyone who's looking at them as a potential investment.
Absolutely.
And speaking of investment, their earnings per share, or EPS, came in at 2.12 for the quarter and 4.35 for the half year. So essentially, that's how much profit is allocated to each outstanding share of the company's stock.
Exactly. And that's a pretty solid return, especially when you consider their balance sheet.
Yeah.
They're showing some really positive signs there, too.
Oh, but yeah.
For instance, their return on capital employed, or ROCE, and return on equity, or ROE, which are both measures of how effectively they're using their capital and assets to generate profit, have actually gone up compared to last year.
Wow, that's great. And their debt-to-equity ratio is down, which is always a good sign.
Right.
It means they're relying less on borrowed money and more on their own financial strength. That's a key indicator of long-term stability.
Think of it like this. Imagine you're managing your personal finances. You wouldn't want to keep piling on debt if you could manage without it, right?
Right.
Well, it's the same principle for companies. A lower debt-to-equity ratio generally means they're in a healthier financial position.
It sounds like they're in a really strong spot financially. They've got a good return on their investments. They're not overburdened with debt, and they're managing their inventory efficiently. So I'm seeing a pretty clear picture of a company that's got its act together.
They really do. And this strong financial footing sets the stage for them to really capitalize on some of the strategic developments they've announced this quarter.
Right.
Things like their acquisition of Log9's battery assets,
Yeah.
which is a pretty big step towards getting into the electric vehicle market.
Yeah, let's talk about that. Jupiter Electric Mobility. Their subsidiary bought Log9's battery assets for both railways and electric trucks. It's a big move.
It's a big move.
Log9 is known for its innovative battery technology, especially in the commercial EV space, so it looks like they're really serious about making a play in this rapidly growing market.
It's a bold move, no doubt, and it will be interesting to see how they integrate these assets into their existing business and translate that into actual market share, because remember, they're stepping into a space with established players who already have a foothold in the electric vehicle ecosystem.
Yeah, it's going to be interesting to see how that all plays out. But before we get too ahead of ourselves, let's stick with the details of what they've actually done this quarter. They've also rebranded Bonatrans India Private Limited to Jupiter Tetravagonka Rail Wheel Factory Private Limited.
And that's not just a cosmetic change.
Okay.
This rebranding reflects their ambition to become a major player in the wheel set market. They've got a plan to increase their production capacity to a whopping 100,000 forged wheel sets. And to achieve that, They're making a significant investment, 250,000 lakh, to build a new facility in Odisha.
That's a lot of money. Where are they getting the capital for all of this?
Well, they recently completed a Qualified Institutional Placement, or QIP, which is basically a way for listed companies to raise capital by issuing shares to qualified institutional buyers.
Right.
Through this QIP, they raised 80,000 lakh, and on top of that, they raised another 3,375 lakh by issuing share warrants.
So it seems like they've got the financial firepower to back up these ambitious plans. And it's not just about expanding into new markets. They're also seeing continued growth in their core business. Their production numbers are up across the board, from railway wagons and CMS crossings to commercial vehicle bodies and components.
And to back that up, they have a robust order book worth over 664,366 lakh.
Yeah.
This shows there's a strong demand for their products, which gives them a pretty solid foundation for future growth.
It's like they're firing on all cylinders, wouldn't you say?
They certainly are, and the managing director's statement actually highlights their strategic shift towards what they call non-wagon businesses as a key area for future growth.
Good.
They're not just a wagon company anymore. They're becoming a much more diversified player in the transportation ecosystem.
That's an interesting point. It sounds like they're trying to position themselves for the future of transportation, whatever that may look like.
Exactly. And that brings us to a point that we should probably address. The auditor's report mentions some outstanding foreign currency payables for Jupiter Tetravagonka Rail Wheel Factory Private Limited.
Right. I saw that too. It seems to be related to some fluctuations in exchange rates. What's the story there?
Well, the company has acknowledged the issue and stated that they're working to resolve it. They've even made provisions in their accounts to cover potential losses. So while it's something to keep an eye on, it doesn't seem to be a major red flag at this point.
Okay, good to know. And let's not forget about the shareholders. They recently declared an interim dividend of 1.00 per share.
That's a nice gesture for the investors and shows that they're sharing their success. It also suggests they're confident in their ability to generate consistent cash flow.
So it seems like they're doing well financially, making strategic moves, and rewarding their shareholders. It sounds like they're striking a good balance between investing for growth and returning value to investors.
I agree. Now, what's really interesting is how their expansion into the electric vehicle space is going to play out in the long run.
Yeah, that's a big question, and I think that's a good place to pause and pick up the conversation in part 2. Okay, so we talked about their strong financial performance, their expansion plans, even that little hiccup with the foreign currency payables. But I think what's really got me thinking is this big move they're making into electric vehicles.
Yeah, it's a huge opportunity, but also a huge challenge. It's like they're trying to build a bridge to the future, and they're not even sure what the other side looks like yet.
Exactly. We were just talking about the acquisition of Log9's battery assets. What does that tell you about their strategy here?
Well, it tells me they're not just dipping their toes in the water, they're diving headfirst.
Yeah.
Acquiring Log9's technology gives them a significant advantage in terms of research and development. They don't have to start from scratch. They're leveraging existing expertise to fast-track their EV ambitions.
It's like they're buying a shortcut, which makes sense in a market that's moving as fast as electric vehicles.
Right.
But they're not just buying technology, right? They're also investing heavily in manufacturing capacity.
Right. That rebranding of Bonatrans India to Jupiter Tetravagonka Rail Wheel Factory, it's a mouthful.
Yeah.
But it signals a much broader scope.
Okay.
They're not just making wheels anymore. They're aiming to become a one-stop shop for railway solutions.
Yeah.
You know, they're talking about integrating battery systems, axles, the whole package.
So imagine this. You're a railway operator, and you're looking to electrify your fleet.
Yeah.
Suddenly you have a single supplier who can provide you with everything you need, from the wheels to the batteries that power the locomotives.
Right.
That's a pretty compelling value proposition.
Yeah, absolutely. And they're putting their money where their mouth is. That 250,000 lakh investment in the new Odisha facility, that's a clear signal that they're serious about scaling up production to meet what they believe will be a growing demand for electric railway
It
solutions.
seems like a classic case of if you build it, they will come. But there's also a risk involved, right? What if the adoption of electric railways doesn't happen as quickly as they anticipate?
Yeah, that's always a risk with any emerging technology, but I think Jupiter Wagons is mitigating that risk by diversifying their EV play.
Going.
They're not just focused on railways, they're also targeting the electric truck market through their subsidiary Jupiter Electric Mobility.
Right, and that market is already showing explosive growth. We're seeing companies all over the world transitioning their fleets to electric trucks, driven by factors like rising fuel costs, environmental regulations, and the push for sustainable transportation.
And this is where Jupiter Wagons' existing expertise in manufacturing and logistics could really give them an edge. They already have a deep understanding of the transportation industry, they have established supply chains, and they know how to build durable, high-quality vehicles.
So they're not starting from scratch. They're leveraging their existing strengths to enter a new market. But there are still challenges, right? They're going up against established players like Tesla, Daimler, and Volvo, who've been in the EV game for a lot longer.
Exactly. And they'll need to develop a strong brand presence in the EV market right now. They're known for wagons and railway components. So they'll need to convince customers that they're also a leader in electric vehicle technology.
And it's not just about the vehicles themselves. They'll need to think about things like charging infrastructure, service networks, and the whole ecosystem that supports electric vehicles.
It's a complex landscape for sure, but I think Jupiter Wagons has shown a willingness to adapt and innovate. They're not afraid to make bold moves and take calculated risks.
It's like they're playing chess, thinking several moves ahead. They're not just reacting to market trends, they're trying to anticipate them and position themselves to be leaders in the future of transportation.
And that's what makes this whole story so fascinating. It's not just about the numbers, it's about a company that's trying to reinvent itself and shape the future of an entire industry.
Okay, so we've looked at the upside, we've acknowledged the risks, and we've seen how they're positioning themselves for the future. But what does it all actually mean for you as someone who's interested in this company? Let's talk about that in part 3. Okay, so we've covered a lot of ground, unpack their financials, their strategic moves, their big push into EVs. But now let's step back and try to connect all the dots. What does all of this mean for you?
Yeah, that's the key question, isn't it? We've seen a company that's performing well in its core business, but also aggressively pursuing growth in new and emerging markets.
Right.
And that presents both opportunities and challenges.
So on the one hand, you have a company with a solid track record, strong financials, and a clear vision for the future. They're making strategic acquisitions, investing in new facilities, and they're clearly not afraid to take risks.
Right. And if those bets pay off, if they're able to successfully navigate the complexities of the EV market, then we could be looking at a company that's poised for significant growth in the coming years.
But on the other hand, there are risks involved. The EV market is incredibly competitive with established players who have a head start.
Right.
And there's no guarantee that their strategy will succeed.
Exactly. And it's important to remember that the transition to electric vehicles is still in its early stages. There are a lot of unknowns, and the technology is constantly evolving. What works today might be obsolete tomorrow.
So what should you be watching for as you follow Jupiter Wagons' story?
Okay.
I think one key indicator will be their ability to execute on their EV strategy.
Yeah.
Can they convert those ambitious plans into actual market share and revenue?
Absolutely. Keep an eye on their partnerships, their product launches, and how they're building out that EV ecosystem we talked about.
Right.
Are they attracting top talent? Are they securing deals with key customers?
Right.
Those are all signs of progress.
Another thing to watch is their ability to balance growth with profitability. Can they maintain those healthy margins as they invest heavily in new areas?
Right. And how effectively are they managing their debt levels as they take on these ambitious projects? That's something else to keep in mind.
So it's a mixed bag, right? There's a lot of potential, but also a lot of uncertainty.
Yeah.
It's a classic high-risk, high-reward scenario.
And that's why it's so important to do your own research, stay informed, and make decisions that align with your own investment goals and risk tolerance.
Absolutely.
Yeah.
We've given you the key takeaways from the information you provided, but ultimately the decision of what to do with this information is yours.
Think of this deep dive as a starting point. We've equipped you with some insights and perspectives, but now it's up to you to dig deeper, ask your own questions, and draw your own conclusions.
And that's what makes this so exciting. Jupiter Wagons is a company in motion, and it's going to be fascinating to watch how their story unfolds.
Indeed, the future of transportation is being written right now, and Jupiter Wagons is right there in the thick of it.
Well, thanks for breaking it all down with me.
My pleasure.
All right, that's it for this deep dive on Jupiter Wagons. We'll catch you next time.